Imagine the planet's second-largest economy, the engine that powered global growth for 2 decades, not collapsing overnight, but disassembling slowly, piece by piece, like a skyscraper whose bolts are being removed one by one. No single headline will capture it. No politician will wave a magic wand. Instead, it's a controlled demolition in slow motion, a cascade of real estate implosion, soaring local debt, demographic decline, and manufacturing reshoring that together are rewriting the rules of global trade and finance. If you think this is just China slowing down, think bigger. This is structural, this is generational, and it matters to your job, your investments, and the global economy you depend on. Let's start with the most explosive ingredient in this cocktail: real estate. For years, China's growth story rode on property, home building, construction, materials, and the whole value chain. At its peak, real estate plus construction and related sectors accounted for roughly 25 to 32% of China's GDP, depending on how you measure it, a far higher share than in most major economies. That means when property stalls, it doesn't nibble at GDP, it bites deep. The scale of the slowdown is staggering. Housing investment and property sales have plunged from peak levels. New construction starts have collapsed in some years by 50 to 70% in floor space terms, and sales have fallen dramatically, squeezing developers' cash flows and triggering a chain of defaults and restructurings across the sector. The IMF warned that real estate investment could fall 30 to 60% below 2022 levels in downside scenarios, a hit comparable to the worst housing slumps in advanced economies. That's not a small cyclical wobble, it's a structural retrenchment. You know the headlines about Evergrande, but the problem is much larger than one firm. China's biggest property developers piled up enormous off-balance sheet liabilities, and many local governments funded growth through land sale revenue and off-books borrowing vehicles. Evergrande's debts were measured in the hundreds of billions of dollars, and its failure was only the most visible symptom of a much wider balance sheet stress across the sector. When developers stop building, suppliers, steel plants, cement makers, construction equipment firms, and local tax bases all feel the shock, and that shock multiplies through the economy. That brings us to the next major fracture: local government finances. China's infrastructure boom was often financed via local government financing vehicles, LGFVs, and shadow borrowing that grew massively over the last decade. Recent estimates put LGFV-like and related local borrowing at a very large share of GDP, with some researchers and central banks flagging figures in the tens of percent of GDP, and official reforms in 2024 to 2025 pivoting to swap and formalize hidden debts into state-backed bonds. Translating off-books debt into on-books liabilities is a short-term fix for liquidity, but it also exposes the true scale of local stress and pins the central government to a political and fiscal balancing act. Underneath the fiscal and credit mess is a demographic tsunami. China's decades-long population advantage, an abundant cohort of young workers fueling manufacturing, has reversed. Birth rates plunged, the population fell in recent years, and projections show rapid aging, with the share of people aged 65 plus set to surge over the next 2 decades. By 2040, some projections estimate China will have a much larger elderly population that will place enormous strain on pensions, healthcare, and social services while shrinking the worker base that produces goods and pays taxes. This isn't a small policy tweak. It reshapes labor costs, consumption patterns, and long-run growth potential. The demographic pinch shows up today in troubling microdata. Youth unemployment and underemployment are unusually high for a middle-income country. Urban youth joblessness has been reported in the high teens percentage range in recent years, reflecting structural mismatches between the skills market needs and the economy's ability to create stable, decent-paying jobs at scale. High youth unemployment is a social risk, but it's also an economic warning sign. Fewer career starters means weaker consumer demand and less innovation over time. Now stitch these internal stresses to the global web. China has been the world's largest consumer of commodities and a dominant buyer of raw materials: iron ore, copper, steel, cement, coal. For decades, Chinese construction absorbed a huge share of global commodity demand. When its property sector halts, the knock-on effect is immediate and brutal for exporters from Australia, Brazil, and African mineral exporters. In 2024, steel consumption and other commodity flows showed meaningful declines in China's share, and markets that built capacity around China distributed demand have had to scramble for clients or cut output. The global China growth cushion is shrinking. But the shock doesn't stop at raw materials. Global supply chains are being rewired. The era of China-only manufacturing is ending. Companies are diversifying, moving assembly and packaging to Vietnam, India, Southeast Asia, and parts of Mexico. Apple, Foxconn, and many electronics value chain firms have accelerated plans to expand in India, Vietnam, and elsewhere. That migration is not friction-free. It costs billions, disrupts procurement, and raises production costs in the short run. And it reduces the role of Chinese factories as the world's default assembler over time. That matters for jobs and tax revenues in China, and for pricing, availability, and corporate profits globally. All of this feeds market nervousness. Investors and traders look at weaker export orders, lower commodity imports, falling property sales, and rising local debt recognition, and see not just a cyclical slowdown, but the contours of a restructuring that could take decades. Equity markets with heavy China exposure wobble. Emerging market funds and commodity-linked stocks feel the spillover. Global growth forecasts are trimmed. Because China was such a big engine of global demand for the past 20 years, a long-term slowdown has outsized global knock-on effects. Finally, note the policy dilemma. Beijing can use fiscal stimulus, debt swaps, and targeted support, and it has, announcing large-scale debt swap programs and infrastructure pushes to stabilize growth. But the authorities also fear reinflating unsustainable asset bubbles and must manage financial stability risks and social consequences. The political calculus, balancing growth support with financial reform and social stability, is a tightrope. The tools exist, but they are costly, and the long-term fixes require deep structural changes. Boosting family-friendly policies, redesigning pensions, reforming local government financing, and shifting towards service-led, higher-value growth. Those are generational projects, not instant fixes. So what does this mean for you? In short, prepare for a multi-phase transition. Not necessarily cataclysm, but a prolonged period where global demand patterns, commodity prices, supply chains, and investment flows adjust to a China that's slower, older, and structurally different. That translates into market volatility, shifting employment opportunities, and new geopolitical alignments. For savers and investors, it means reassessing China-heavy exposures, diversifying across markets and sectors, and watching commodity-sensitive positions closely. For businesses, it means reevaluating supply chain concentration and customer mix risks. And for policymakers, it means hard choices about fiscal space, social insurance, and the pace of reform. How the shock actually propagates. 4 fast transmission channels. Trade and commodity channel. China still consumes a disproportionate share of global commodities: iron ore, copper, coal, agricultural raw materials. When Chinese steelmaking and construction slow, commodity exporters, Australia, Brazil, parts of Africa, feel it fast. Iron ore flows fell modestly in early 2025, and futures have shown volatility tied to weaker Chinese demand, moving key mining and energy equities. That matters. Miners cut output fast, capex gets delayed, and countries dependent on commodity revenues face fiscal squeezes. Corporate and supply chain channel. Manufacturers that built China-only supply chains are rewiring to China plus one strategies, moving assembly to Vietnam, India, Mexico, and Southeast Asia. That creates short-term cost inflation, retooling, logistics, and longer-term shifts in where products are made and who benefits. Bottom line, the slow collapse is a strategic pivot, not necessarily an immediate Armageddon. What's unfolding in China is complex and multi-decadal. Heavy balance sheet repairs, demographic shifts, and a reorientation from property/investment-led growth to services and consumption. That transition can be bumpy and can create global economic headwinds, but it also offers winners for patient, well-prepared investors and businesses. The prudent response isn't panic. It's diagnosis, de-risking, diversification, and opportunistic repositioning. If this piece sharpened your view, do one practical thing now. Scan your investments for China revenue exposure. Many ETFs and mutual funds disclose country revenue splits. And set a plan, rebalance or hedge, based on a realistic downside scenario. For weekly breakdowns, deep dives, and tactical checklists, subscribe to Finance Facts. Stay informed, stay prepared.